Have you ever wondered why, if you enter a trade, price will pull you out of the trade first before moving in a direction? And you'll be frustrated thinking that the algorithm or institutions are putting eyes on your stop loss. This may not be the case, but then you have to understand the stop loss hunt concept for you to trade efficiently and effectively with your stop loss being protected in most cases. So I'll take you through this concept, and at the end, you'll be able to know how to approach this professionally. Now, the institutions does not really have an eye on where your stop loss is, but what the institutions, what the market does is to hunt for stop loss or hunt for liquidity, not really stop loss, hunting for liquidity, picking orders where orders are residing, and then using it to move in a certain direction. As in this case, this is the high and this is the low. And according to retail way of trading, whenever we are trading, if we enter sell here, our stop loss will be above this high. And there's two ways to this thing. Why? Because we still have breakout traders that are waiting for price to break out of this high so that they will enter their buy here. So while there are stop loss here, there are also buy stop orders. There are there are buy stop orders here also that will sell in case if price is moving opposite them. And there are also buy orders here. There are also buy orders here. As much as there are buy stop orders, these are orders too, just like your entry order. Just like your entry order, like your market order, people put buy stop order to stop the trade from going into a deep negative and making them to lose more in the market. And there are also buy orders for breakout traders that are waiting for for this price to break out of this zone and they will enter buy. The same thing here. If we enter trade here as retail traders, we want to put our stop loss below the odd low in a buy setup. And then, you know, there are traders that are waiting for price to break out of this low too to sell as a breakout trader. So that is what makes these zones to be very important in forex trading. And what really drives the market? The algorithm is driven by liquidity. It is the liquidity in the market that drives the market, and that is why institutions cannot trade without so much liquidity in the market. In their key zone, they sponsor liquidity to trade. You have to know how to trade this way for you to be profitable in this forex market. So, how do you approach this? How do you approach this uh, setup and trade efficiently? You have to look for area of liquidity and then where price will sweep this liquidity, and your entry should be after price have swept the liquidity, then you enter your trade and you'll be able to ride on the trend effectively, efficiently without being frustrated of your stop loss being hit. After price has taken liquidity, there you should look out for area of demand or supply in this case that is above the liquidity level. Look out for area of supply that is above the liquidity level, and this should be your entry. But whenever you're trying to enter, putting your stop loss above this high, there's tendency that price is going to disappoint you and taken out of the trade, the price will dip into area of demand, then it will ride on. The same thing with this. You should look out for area of demand, area of demand below this low, area of demand below the low. And this is where you should frame your entry. Your entry should be framed based on the area of demand that is below this low after price has taken out the liquidity below this low and the stop loss will be protected here. So this is what happened in most cases with price action. Can you see this price action? We have this low, we have this high, and we have this low. We have this high, we have this low, and this is your maybe entry, right? This is your entry here. You are trying to enter here because why? You have a market structure break here, and then it is expected that it is a market structure shift here, and you want to enter at this area of supply. But what happened was price took out this high. Price took out the high. Price took out this high. Can you see how price took out the high and then traded into a demand zone? Traded into a demand zone here, right? So if your entry would have been here in this area of demand and your stop loss above this particular high, you are protected already. Same thing happened here. Price took out this low, took out this low also, took out this low and was protected here. Can you see it? Can you see this zone? Can you see this zone? Just below this low, just below this low is area of demand here. This area of demand here, while this is supply, this is demand. The price got protected here. There are so many other examples of this happening in the market. And these are places where these are things that you need to pay attention to it in forex trading. Can you see here? Suppose price is supposed to move bullish. Why? Because you had this consolidation and then break out of consolidation. But price refused to be held by this and broke out of this low after breaking out bullishly from the consolidation. If you check on your left side, you will see area of demand. Can you see it? Can you see? Can you see it? Price dipped into area of demand and then continue forward. So this is how you trade liquidity concept or stop loss concept. You identify where liquidity is, identify the next available area of demand or supply as the case may be, and then trade off the area of demand below the liquidity level or from the area of supply above the liquidity level. With this, you'll be able to beat the liquidity concept and be profitable, and you will not be frustrated that your stop loss is always the target. Thank you guys. If you like this content, follow me for more, and I wish you all the best.